The Magic Formula, The Life, Philosophy, and Accessible Genius of Joel Greenblatt. Good morning and welcome. In our journey through the world of investing greats, we have encountered complex systems, intense psychological demands, and strategies that require near constant attention. Today, we turn our attention to a figure who stands as a beacon of simplicity and intellectual elegance in a field often shrouded in unnecessary complexity. He is a master who achieved one of the most spectacular investment track records in history, and then performed an even more remarkable feat. He distilled his immensely successful strategy into a simple, mechanical formula that any investor could follow. He is a bridge builder, connecting the lofty halls of professional finance with the kitchen tables of everyday people. He demystified the art of investing, transforming it from a mysterious craft into a systematic science, all while highlighting the one variable that no formula can ever fully eliminate: the human heart. His name is Joel Greenblatt, the founder of Gotham Capital, a professor at Columbia Business School, and the author of the best-selling book, The Little Book That Beats the Market. His story is not one of a reclusive genius, but of a generous teacher. It is a story that explores one of the most profound and persistent puzzles in finance. Why do simple, proven strategies so often fail in the hands of those who try to implement them? His career offers a masterclass in quantitative value investing, behavioral finance, and the immense power of patient, systematic execution over frantic, emotional decision-making. He is the man who gave us the keys to the kingdom and then patiently explained why so many would be afraid to turn the lock. Part 1. The Apprentice. Learning the Craft of Value. Investing Joel Greenblatt was born in 1957 and grew up in a middle-class family. He displayed an early aptitude for numbers and systems, a mind that naturally sought out patterns and logical frameworks. He attended the Wharton School at the University of Pennsylvania, where he earned a BS in economics, and then, in a move that showcased both his intellect and his pragmatic approach to building a career, went on to obtain a JD from the University of Pennsylvania Law School. The law represented a stable, prestigious profession. However, the pull of the market, the intellectual puzzle of pricing, and the thrill of finding an edge was too strong. He never practiced law. Instead, he dove headfirst into the world of finance, taking a job at a hedge fund where he cut his teeth on the intricate principles of risk arbitrage and special situations investing. This early experience was crucial. It was here that he learned to think not in certainties, but in probabilities. Risk arbitrage, which involves betting on the successful completion of mergers and acquisitions, requires a cold-eyed assessment of the likelihood of various outcomes, the potential payoffs, and the consequences of failure. It taught him to analyze corporate events with a dispassionate, calculating eye, and to always demand a margin of safety for being wrong. But his true intellectual foundation was laid when he discovered the works of Benjamin Graham and Warren Buffett. The core principle of value investing, buying a dollar's worth of assets for 50 cents, resonated deeply with his logical and systematic mind. He understood that the market was not a perfectly efficient pricing machine, but an emotional voting machine in the short term, which occasionally, and often dramatically, offered up fantastic bargains for those with the patience and discipline to seize them. In 1985, with a relatively modest amount of seed capital, reportedly just $7 million, a portion of which came from the notorious financier Michael Milken Greenblatt, founded his own hedge fund, Gotham Capital. He was 27 years old. His strategy was a focused, intensive application of classic value investing principles, but with a twist of his own analytical rigor. He specialized in what are known as cigar butt investments, small, obscure, and often deeply troubled companies that were trading far below their net current asset value. These were the ultimate Graham-style bargains companies you could buy for less than the value of their cash and inventories alone, effectively getting their ongoing operations for free. He would also engage in spin-offs, mergers, and other complex corporate events where fear, complexity, and a lack of analyst coverage had created profound mispricing. The results over the next decade were nothing short of breathtaking. From 1985 through 1994, Gotham Capital generated annualized returns of 50% after fees. To put that in perspective, an investment of $100,000 with Greenblatt at the inception of Gotham would have grown to over $12 million in just 10 years. This is one of the most extraordinary runs in the history of the hedge fund industry, a track record that placed him in the pantheon of investing legends. He had proven beyond any doubt that he was a master of his craft. He had the Midas touch, built not on luck, but on a relentless, disciplined application of value principles. And then, at the peak of his success, he did something that stunned the financial world. He gave back a significant portion of his outside investors' capital and dramatically scaled back the fund's activities. He had achieved his financial goals and was now driven by a different, more profound purpose, the desire to teach, to demystify, and to give back. Part 2. The genesis of the magic formula, a search for simplicity. As Greenblatt began teaching a course on value investing at Columbia Business School, he faced a fundamental pedagogical challenge. The principles of Graham and Dodd, while powerful, could be complex and required significant judgment and experience to apply correctly. How could he convey the essence of this powerful philosophy to students and ultimately to the general public in a way that was both understandable and executable? He wanted to find a way to codify the core of a good value investment into a simple, repeatable process that did not require the intensive company-by-company forensic analysis that he had employed at Gotham. He asked himself a profound question. Could the genius of value investing be systematized? This question led him back to the data. He embarked on a massive research project, backtesting a simple two-variable investment strategy over a period of 17 years. The results were astonishing. This simple, mechanical strategy had nearly doubled the return of the S&P 500 over that period, with back-tested annual returns approaching 30%. He had discovered what he would later, with a touch of self-deprecating humor, call the magic formula. The magic formula is deceptively simple. It is based on two fundamental concepts, both deeply rooted in the value investing tradition, but combined in a uniquely powerful and systematic way. The first principle, cheapness earnings yield. The formula's measure of cheapness is not the standard price to earnings, PE ratio, which Greenblatt found could be easily manipulated by accounting decisions and ignored a company's debt load. Instead, it uses earnings yield, which is essentially the inverse of the PE ratio, but with a crucial refinement. Specifically, it calculates earnings yield as earnings before interest, and taxes, EBIT, divided by enterprise value, EV. Why this specific formulation? Enterprise value is a more comprehensive measure than market capitalization, as it includes a company's debt and subtracts its cash, representing the true total price to buy the entire business. EBIT operating earnings is used because it focuses on the profit from the core business, before the distorting effects of interest and taxes. So, EBIT EV tells an investor what the company's operating earnings yield would be if they were to buy the entire business, including its debt. A high earnings yield means you are getting a lot of earnings for the price you are paying, the unequivocal hallmark of a bargain. It answers the question, how cheap is this company? The second principle, quality, return on capital. This is the crucial, genius second half of the formula. Greenblatt understood that not all cheap companies are good investments. A company can be cheap because it is a terrible business in a terminal decline, a value trap that will only get cheaper over time. To avoid this, the formula adds a quality screen. It measures quality as return on capital, specifically EBIT, divided by tangible capital employed, net fixed assets plus working capital. A high return on capital indicates that a company is a good business. It is efficiently using its capital to generate high profits. It suggests the presence of a durable competitive advantage or a moat that allows it to earn superior returns on its investments. It answers the question, is this a good business? The magic formula works as follows, a beautiful symphony of screening and ranking. It screens the entire universe of stocks with a minimum market capitalization to ensure liquidity and avoid the tiniest, most illiquid companies. It ranks all these stocks from 1 to, say, 3,000 based on their earnings yield, EBITDA. The stock with the highest earnings yield gets a rank of 1, the second highest gets a rank of 2, and so on. It separately ranks all these stocks from 1 to 3,000 based on their return on capital. The stock with the highest return on capital gets a rank of 1. It then combines the two ranks. A stock that is ranked 50 in earnings yield and 80 in return on capital would have a combined rank of 130. Finally, it selects the 20 to 30 stocks with the best lowest combined ranking to form a portfolio. The elegant genius of this system is that it automatically identifies companies that are both good and cheap. It systematically finds high-quality businesses that, for some temporary reason, a missed earnings quarter, a negative news cycle, industry-wide pessimism, are selling at bargain basement prices. This is the holy grail of investing that active managers spend their careers seeking, wonderful companies at a fair or even unfair price. Part 3. The Public Revelation and the Behavioral Puzzle. In 2005, Greenblatt published The Little Book That Beats the Market. It was a short, simple, and charmingly written book, framed as an explanation for his children and their friends. He laid out the magic formula in its entirety, provided the extensive back-tested results, and even created a free website where anyone could go to get a current list of the top-ranked magic formula stocks. He had done it. He had given away, for the price of a book, a simple mechanical system that had historically crushed the market. The response, however, became a fascinating real-world case study in human psychology. The logical expectation would be that millions of investors would adopt it immediately and achieve superior returns. But that is not what happened. Greenblatt, with his deep understanding of investor behavior, had anticipated the problem. He knew the formula would not work every single week, month, or even year. In fact, he was upfront in stating that the formula would underperform the market in about 1 out of every 4 years, and that it could underperform for stretches of 2 or even 3 years in a row. And this is where the real test begins. The magic formula is not a get-rich-quick scheme. It is a process that requires faith. When investors would use the formula and buy a portfolio of stocks that, to the outside world, often looked like a collection of strange, unloved, and seemingly troubled companies, their resolve would be immediately tested. Why own this unknown industrial parts supplier when everyone is talking about the latest tech darling? When the portfolio underperformed the soaring market for 6 months or a year, as it inevitably would from time to time, the average investor's psychological fortitude would crumble. They would lose faith, abandon the system, convinced it was broken, often right before it was about to stage a dramatic recovery. They would performance chase, selling their formula stocks to buy what was already hot, locking in their losses and missing the subsequent gains. This is the central, brilliant paradox that Greenblatt's work highlights. The biggest obstacle to successful investing is not a lack of a good strategy. It is the investor's own psychology. We are hardwired to follow the herd, to seek safety in the crowd, to chase what is performing well, and to flee from what is performing poorly. The magic formula, by its very contrarian nature, forces an investor to be a loner. It makes them buy companies that the market is currently ignoring or actively disliking. Sticking with the formula during periods of painful underperformance requires a level of discipline and faith in the long-term process that most people find emotionally unbearable. As Greenblatt himself has said, the key to the formula's success is not intelligence, but the ability to stick with it. The formula itself is easy, the temperament to execute it is rare. Part 4. Evolution and the Enduring Principles of Value. Investing Greenblatt did not stop with the magic formula. He continued to teach and write, further refining his explanations of value investing for a popular audience. In his subsequent book, The Big Secret for the Small Investor, he tackled the next logical challenge for those who lack the time or temperament to pick and hold a portfolio of individual stocks, even with a simple formula. His solution? A recommendation to use a systematic, value-weighted index fund approach, which he helped to implement through his firm's creation of the value indexes. This was yet another act of democratization, providing a passive way to tilt a portfolio toward the value factor. His earlier work, You Can Be a Stock Market Genius, delved back into the more complex, special situations investing that powered Gotham's earliest success, exploring niche areas like spin-offs, mergers, restructurings, and rights offerings. This body of work demonstrates the two distinct tiers of his philosophy: a simple, accessible, automated formula for the masses, and a more advanced, intensive, and work-heavy approach for dedicated professional investors. Both, however, are united by the same core principles that form the bedrock of his and all value investing. Mr. Market is your servant, not your master. Greenblatt brilliantly reinforces the Benjamin Graham parable of Mr. Market, the manic, depressive business partner who offers to buy your share of the business or sell you his every day at a wildly different price. The successful investor is the one who ignores Mr. Market's daily, emotionally driven quotes and only deigns to trade with him when the price offered is compellingly irrational. The formula is a tool to ignore Mr. Market's mood swings. Focus on value, not price. The market price is just a quote, a number flickering on a screen. The value is what the entire business is worth based on the cash flows it will generate for its owners over its lifetime. The goal is to buy at a significant discount to that intrinsic value, which the earnings yield component of the formula systematically identifies. Margin of safety is paramount. This is the cornerstone. By buying a business for substantially less than your estimate of its intrinsic value, you build a buffer that protects you from the inevitable errors in your analysis, unforeseen bad news, or simply the vagaries of the market. The magic formula is, in essence, a systematic method for seeking a margin of safety. It's a marathon, not a sprint. The benefits of a value strategy compound over the long term. Short-term underperformance is not a sign of failure. It is often a feature of a successful long-term strategy, as it allows you to continue adding shares of good companies at bargain prices. The 3 to 5 year horizon Greenblatt recommends is the antidote to short-termism. Part 5, The Enduring Legacy of a Teacher. Investor Joel Greenblatt's legacy is multifaceted and profound. He is a rare triple threat, a phenomenal investor who walked the walk, a gifted teacher who could make the complex simple, and a keen observer of human behavior who understood the real-world barriers to success. His first legacy is the democratization of a powerful strategy. By creating and publishing the magic formula, he gave every individual investor a fighting chance to compete with the pros on a level playing field. He provided a transparent, rules-based system that eliminates emotion, hubris, and the noise of the financial media, relying instead on the timeless, quantitative principles of buying good businesses at bargain prices. His second legacy is the illumination of the behavioral gap. His work provides one of the clearest demonstrations in financial history that the gap between investment returns and investor returns is vast. A strategy can be brilliant on paper and in backtests, but it is useless in practice if human psychology prevents its consistent execution. He taught us that the most important investment we can make is in understanding and controlling our own emotional responses, in cultivating the temperament of a patient owner rather than a frantic trader. His third legacy is the emphasis on process over outcome. The magic formula is not about picking one winning stock. It is about faithfully following a process that, over time and over a portfolio of stocks, has a high probability of success. This focus on systematic, repeatable process is the hallmark of a professional approach, and he packaged it for mass consumption. It is the antithesis of stock picking as a form of gambling or entertainment. His final legacy is one of intellectual generosity. Unlike many financial titans who guard their secrets closely, viewing them as a source of perpetual advantage, Greenblatt chose to share his. He has dedicated a significant portion of his life to educating the next generation of investors at Columbia and empowering the individual through his writing. He represents the very best of the finance profession, a powerful combination of supreme skill, intellectual clarity, and a sincere desire to uplift others. In conclusion, Joel Greenblatt is more than just the creator of the magic formula. He is a philosopher king of the practical. He took the esoteric, judgment-heavy art of value investing and transformed it into a simple, executable science. More importantly, he identified the true enemy of investment success, our own ingrained psychological biases, and provided a systematic shield against them in the form of a disciplined, unemotional process. He proved that you don't need a complex algorithm, a Wall Street terminal, or a gift for prophecy to be a successful investor. What you need is a sound, time-tested principle, the intellectual humility to follow a system even when it feels uncomfortable, the discipline to stick with it through inevitable periods of doubt, and the profound patience to let the relentless power of compounding do its quiet, magnificent work. In a world of financial noise, confusion, and self-proclaimed gurus, the clear, logical, and generous voice of Joel Greenblatt remains a guiding light. Thank you.